Statistical Wizardry, Mastering Audit Sampling for Account Balances. Introduction. Ladies and gentlemen, buckle up. Today we're diving into the world of audit sampling, where we're going to learn how to examine just a fraction of a company's transactions, but speak confidently about all of them. This is the statistical magic that keeps auditors from having to test millions of transactions while still sleeping well at night. Picture this. You're an auditor at Tesla, looking at their $81 billion in annual revenue. Are you going to test all 2 million vehicle sales transactions? Of course not. You'll test maybe 100 transactions and then make a statistical leap that would make Evel Knievel nervous. That's audit sampling, and today you're going to master it. Real-world audit story. Now, before we dive in, let me tell you about the time I was auditing a major clothing retailer during Black Friday season. We needed to audit their inventory, but there were thousands of SKUs across 500 stores. The partner comes to me and says, "We need 95% confidence by tomorrow morning." I looked at my team of 3 staff auditors and thought, oh boy, we're about to become statistical wizards overnight. You know what saved us? The very formulas and techniques I'm about to teach you today. By the end of this lecture, you'll have the power to look at a tiny sample and make million-dollar decisions with mathematical confidence. And that, my friends, is a superpower in the business world. Key sampling terminology. All right, let's get into it. Audit sampling is like dating. You don't need to meet every potential partner to know what you like and don't like. You just need a representative sample. This is the foundation of audit efficiency, allowing us to reach reasonable conclusions without testing everything. Let's nail down some essential definitions first. The population is the entire set of data you want to draw conclusions about. For example, all 50,000 inventory items at year-end, or all 120,000 sales transactions for the year. It's critically important to properly define your population before sampling begins, because your conclusions will only apply to the defined population. The sampling unit refers to the individual items making up the population. Depending on the test objective, your sampling unit might be individual customers, specific invoices, inventory items, or even individual line items on purchase orders. Clearly, defining your sampling unit is essential for proper selection and evaluation. A sample is the subset of items you're actually going to test, those lucky few that get selected for your detailed scrutiny. The key is that these items must be representative of the population, which requires proper selection techniques. Sampling risk is the possibility your sample leads you to the wrong conclusion. Since you're not examining everything, there's always a risk that your sample isn't representative of the entire population. This is the fundamental trade-off in sampling. We save time and resources, but we introduce risk that must be quantified and managed. Sampling risk types. In audit terms, sampling risk is the possibility that your conclusion based on your sample is different from what you'd conclude if you examined everything. There are 2 types of sampling risk that every auditor needs to understand in detail. Risk of incorrect acceptance, or beta risk, is typically set at 5%. Think of this as the false negative of auditing, missing material misstatements that are actually there. This is what keeps auditors up at night. It represents the risk that your sample leads you to conclude that an account balance is fairly stated when it actually contains a material misstatement. This could lead to an inappropriate audit opinion and potential legal liability, which is why managing this risk is paramount. Risk of incorrect rejection, or alpha risk, is also typically 5%. This is the false positive, concluding there's a material misstatement when there actually isn't. This just wastes everyone's time and annoys the client. It represents the risk that your sample leads you to conclude that an account balance is materially misstated when it's actually fairly stated. While less dangerous from a liability perspective, it's still inefficient and can damage client relationships. Confidence level. Now listen up, because this is money math. Your confidence level is simply 100% minus your beta risk. So with a beta risk of 5%, your confidence level is 95%. That's the number you'll brag about in your audit report. The confidence level represents how sure you are that your conclusion based on the sample is correct. A 95% confidence level means that if you repeated the sampling procedure 100 times, you would expect to reach the correct conclusion 95 times. The formula is elegantly simple. Confidence level equals 100% minus beta. This gives us the statistical power to make assertions about large populations based on relatively small samples. The higher your desired confidence level, the larger your required sample size will be. It's a direct mathematical relationship that we'll explore more when we discuss sample size determination. Let me give you a real-world example. When Apple's auditors, Ernst & Young, test their $394 billion in assets, they're using these exact formulas. They might test only 200 items out of millions, but can still say with 95% confidence that the financial statements are free from material misstatement. That's power, people. This statistical confidence forms the backbone of the global audit profession and allows vast multinational corporations to be audited efficiently. Statistical versus non-statistical sampling. Now here's where it gets interesting. There are two approaches to sampling: statistical and non-statistical. Statistical sampling is like using a dating app with a sophisticated algorithm. Very precise, very defensible. Non-statistical is more like asking your friends to set you up. It relies on professional judgment. Statistical sampling uses probability theory for both sample selection and evaluation. It requires random selection of items where each item has a known probability of selection. This approach allows us to mathematically quantify sampling risk and calculate precision, the numerical measure of potential sampling error. While more complex, it provides stronger evidence and more defensible conclusions, especially in litigation-prone environments. Non-statistical sampling, in contrast, relies heavily on auditor judgment. The auditor uses professional judgment to determine sample size, select items, and evaluate results. While this approach is more flexible and often less time-consuming, it cannot mathematically quantify sampling risk. Many auditors use a hybrid approach in practice, applying statistical concepts to non-statistical samples to get the best of both worlds. Let me tell you, I've been in meetings where the PCAOB is breathing down our necks, questioning our sample sizes, and let me tell you, having a statistical basis for your sample size is like having a force field around you. It provides a defensible, objective basis for your decisions that can withstand regulatory scrutiny. Quick question. If you're auditing cash at Bank of America, would you use statistical or non-statistical sampling? Anyone? This is a classic case where statistical sampling would be preferred due to the high volume of transactions, high risk, and potential regulatory scrutiny. The mathematical precision of statistical sampling provides stronger evidence for such a significant account. Quantifying the difference. The difference is quantifiable. With statistical sampling, I can tell you precisely that I'm 95% confident the true misstatement is between $32,500 and $67,500. With non-statistical, I can only say, in my professional judgment, the misstatement isn't material. Which sounds more defensible in court? That's what I thought. Statistical sampling provides a precise confidence interval, a range within which the true population value is likely to fall with a specified level of confidence. This gives audit committees, regulators, and courts a clear understanding of the precision of our testing. For example, if we project a misstatement of $50,000 with precision of plus or minus $17,500 at 95% confidence, we're explicitly stating that we're 95% confident the true misstatement is between $32,500 and $67,500. Non-statistical sampling cannot provide this level of precision. The conclusions are more subjective and rely heavily on the auditor's professional judgment, making them harder to defend against challenges. While valid in many circumstances, non-statistical approaches don't provide the same level of mathematical rigor when scrutiny increases. Monetary unit sampling formula. Now we're getting to the heart of it. How many items do you need to test? This is where the rubber meets the road, folks. Determining the right sample size is critical. Too few items and you don't have sufficient evidence. Too many and you're wasting valuable resources. For monetary unit sampling, which is what most firms use for substantive testing, here's the formula that will save your career. N equals TB times RF divided by TM, where N equals sample size, how many items you're testing, TB, total book value, the account balance, RF, risk factor based on your confidence level, and TM, tolerable misstatement, how wrong is too wrong. This formula is elegant in its simplicity but powerful in its application. MUS is particularly effective for testing accounts where the primary risk is overstatement, like accounts receivable or inventory. The formula directly incorporates the account balance size, terabytes, your required confidence level through the risk factor, and your materiality considerations through tolerable misstatement. Tolerable misstatement deserves special attention. It's the maximum monetary misstatement that could exist in an account balance without causing the financial statements to be materially misstated. It's typically set as a percentage of materiality, often around 50 to 75% of overall materiality, though this can vary based on risk assessments and other factors. Risk factors table. And here are the risk factors you need to memorize. These are the values that translate your desired confidence level into a mathematical factor for the formula. 90% confidence, RF equals 2.31, 95% confidence, RF equals 3.00, 99% confidence, RF equals 4.61. These risk factors come from statistical probability distributions and represent the number of standard deviations from the mean in a normal distribution. For 95% confidence, we use 3.00 rather than the textbook 1.96 because MUS uses a Poisson distribution, which better models rare events like misstatements. Notice how the risk factor increases significantly as you move from 90% to 99% confidence. This is why high confidence audits require substantially larger sample sizes. The relationship isn't linear. It takes disproportionately more testing to achieve those last few percentage points of confidence. These formulas aren't just academic exercises, people. When I was at a Big Four firm, we used these exact formulas to determine if we needed to test 50 items or 500. And let me tell you, the difference meant going home at 8 p.m. versus sleeping under your desk. Proper sample size determination is the difference between efficient audits and budget nightmares. Walmart sample size example. Let's say you're auditing the $5 billion inventory at Walmart. Your materiality is $100 million and you want 95% confidence. How many items do you test? This is the kind of real-world scenario you'll face, so let's work through it step by step. Let's break it down together using our MUS formula. Total book value, $5 billion, risk factor at 95% confidence, 3.00, tolerable misstatement, $100 million, N equals $5 billion times 3.00. $3 divided by $100 million equals 150 items. This is your base sample size, assuming no errors. But wait, if you expect errors, and trust me, at Walmart's scale, there will be errors. You need to adjust this number up. The presence of expected errors increases the sample size because we need more items to properly estimate the error rate. If you expect a 1% error rate, multiply by the appropriate expansion factor of 1.5. Final sample size equals 150 times 1.5 equals 225 items. The expansion factor accounts for the expected errors and ensures your sample remains large enough to draw valid conclusions even when errors are found. As expected, error rates increase, expansion factors also increase. For a 2% expected error rate, the factor might be 1.6. For 5%, it could be 1.9 or higher. Classical variables. Sampling. Now for classical variables sampling, which we sometimes use for populations with high variability, the formula is different. N equals, open parenthesis, NR times sigma, close parenthesis, squared, divided by Tm squared, where NR equals normal risk factor, 1.96 for 95% confidence, sigma equals standard deviation of the population, and Tm equals tolerable misstatement. This formula focuses on the variability of the population as measured by the standard deviation. The more variable your population, the larger your required sample size, which makes intuitive sense because more variability means less predictability, requiring more testing to reach conclusions. Classical variables sampling is particularly useful when testing for both overstatement and understatement, or when dealing with highly variable populations. It's also useful for estimating quantities rather than simply testing for misstatements. However, it requires more information about the population, specifically the standard deviation, which may require a preliminary sample to estimate. The normal risk factors come directly from the standard normal distribution, 1.64 for 90% confidence, 1.96 for 95% confidence, and 2.58 for 100% confidence, 99% confidence. Note these are different from the MUS risk factors we discussed earlier because they're based on different statistical distributions. Audit risk model connection. There's one more critical factor in sample size determination, the relationship with the audit risk model. Remember that formula from Chapter 3? AR equals IR times CR times DR, where AR is audit risk, IR is inherent risk, CR is control risk, and DR is detection risk. Detection risk directly impacts your sample size. The lower your detection risk, the higher your required confidence level, the larger your sample size. This is why risk assessment is so crucial to audit efficiency. Lower risk assessments allow for smaller sample sizes while maintaining the same overall audit risk. The audit risk model provides the theoretical foundation for sampling. We typically set audit risk at 5%, meaning we're willing to accept a 5% risk of issuing an unmodified opinion when the financial statements contain a material misstatement. Our risk assessments for inherent risk and control risk then determine how much detection risk we can accept, which directly translates to sample size. High inherent risk or control risk assessments force us to compensate with lower detection risk, which means larger sample sizes. Conversely, effective controls and low inherent risk allow for higher detection risk and smaller sample sizes. This is why performing thorough risk assessments is so important. They directly impact audit efficiency. Detection risk calculation. Let's say your audit risk is 5%, inherent risk is 100%, and control risk is 60%. You need to determine your detection risk, which will then dictate your required confidence level and sample size. DR, AR, IR x CR, DR, CR, 5%, 100% x 60%, 5%, 60%, 8.33%. This means your confidence level needs to be 91.67%, 100% minus 8.33%, which affects your risk factor and ultimately your sample size. If we interpolate between a 90% risk factor, 2.31, and a 95% risk factor, 3.00, we get approximately 2.8 for 91.67% confidence. This demonstrates the direct mathematical relationship between your risk assessments and your sample sizes. If you were able to assess control risk at 40% instead of 60%, Perhaps after testing controls and finding them effective, your detection risk would increase to 12.5%, reducing your required confidence level to 87.5%, and shrinking your sample size by about 20%. This is why integrated audits, where we test controls and use the results to reduce substantive testing, can be so efficient. Effective controls allow for significantly smaller substantive samples while maintaining the same overall audit risk. It's all about finding the right balance of procedures to achieve the desired assurance level efficiently. Sample selection methods overview. Now that we know how many items to test, we need to know which ones. This is where the magic happens. The method used to select your sample is just as important as the sample size itself. A poorly selected sample, even of adequate size, may not provide valid conclusions. Remember this mantra: random is fair, but stratified is smart. This captures the essence of sample selection. Randomness ensures representativeness, but stratification enhances efficiency. Let me break down some selection methods in detail. 1. Systematic selection. Take every nth item based on a sampling interval. Formula: sampling interval equals population value divided by sample size. This approach is efficient and easy to apply, especially for large populations. You choose a random starting point, then select items at regular intervals. It provides good coverage across the entire population, but can introduce bias if the population has patterns or cycles that coincide with the sampling interval. 2. Random selection. Every item has an equal chance of selection, like a lottery, except the winners get audited. True random selection requires using random number generators or random number tables. This approach provides the strongest statistical basis for conclusions and avoids potential pattern-based bias. But it can be more time-consuming to implement and may result in uneven coverage of the population. 3. Haphazard selection. Select without conscious bias. This is like picking items while blindfolded. Spoiler alert, humans are terrible at this. Studies show we naturally avoid certain patterns. While seemingly random, research has shown that humans are inherently poor at selecting items randomly. We tend to avoid certain patterns, favor others, and introduce unconscious biases. This method is generally less preferred than statistical methods, but may be acceptable for low-risk areas. 4th block selection, consecutive sequence of items. Generally not recommended for substantive testing because it lacks representativeness. Block selection examines items that occur together in sequence, which can be efficient, but severely limits your ability to project results to the entire population. Items that occur together often share characteristics, making the sample unrepresentative. This method might be appropriate for specific procedures like testing cutoff, but not for most substantive testing. 5. Monetary unit sampling. Selection probability proportional to dollar value. This is the Rolls-Royce of sampling methods. MUS automatically focuses on larger dollar items, giving each dollar in the population an equal chance of selection. This means high-value items are more likely to be selected than low-value items, which aligns with the audit risk of material misstatement. It's particularly effective for detecting overstatements in populations where errors are expected to be proportional to item size. MUS selection, step by step. For monetary unit sampling, here's how you do it step by step in practical terms. Step 1. Calculate your sampling interval by dividing the population value by your sample size. For example, $5 million divided by 225 equals $22,222. This means we'll select an item for testing at every $22,222 interval in the cumulative population. Step 2. Choose a random starting point between $1 and your sampling interval, $22,222. Let's say we randomly select $15,000 as our starting point. This ensures that our first selection is randomized within the first interval. Step 3. Your selection points are calculated by adding the sampling interval to each previous point. $15,000. $15,000 plus $22,222 equals $37,222. $37,222 plus $22,222 equals $59,444, and so on, until you've identified all needed selection points. These are the specific dollar amounts we'll be looking for in the cumulative population. Step 4. Select the items containing those cumulative dollar amounts. To do this, you arrange your population in any sequence and calculate a running cumulative total. Whenever a cumulative total includes one of your selection points, you select that item for testing. The beauty of MUS is that it automatically ensures that larger items have a higher probability of selection. An item that's twice as large as another has twice the chance of being selected. This aligns perfectly with the audit risk of material misstatement. We care more about large misstatements than small ones. Selection table example. Here's a concrete example showing exactly how MUS selection works in practice. Imagine we have the following accounts receivable balances, and we're selecting using the method we just discussed. Customer Alpha Inc. has a balance of $12,500, making the cumulative total $12,500. Our first selection point is $15,000, which is not contained within this account, so we don't select it. Customer Beta Corp has a balance of $18,000, making the cumulative total $30,500. Our first selection point of $15,000 is contained within this account, between $12,500 and $30,500, so we select Beta Corporation for testing. Customer Gamma LLC has a balance of $10,000, making the cumulative total $40,500. Our second selection point of $37,222 is contained within this account, between $30,500 and $40,500. So we select Gamma LLC for testing. Customer Delta Co. has a balance of $25,000, making the cumulative total $65,500. Our third selection point of $59,444 is contained within this account, between $40,500 and $65,500. So we select Delta Company for testing. This process continues until we've identified all 225 sample items. The selected items will naturally include more high-dollar accounts, which is exactly what we want for efficient testing. Notice how a customer with a $25,000 balance, Delta Co., has approximately twice the chance of being selected as one with a $12,500 balance, Alpha Inc. This is the proportional to size feature of MUS working as designed. Stratification benefits. Let me tell you why stratification is the LeBron James of sampling. When I was auditing a luxury retail chain, their inventory ranged from $5 earrings to $50,000 watches. If we used simple random sampling, we might miss the high-value items entirely. Stratification involves dividing the population into groups, strata, based on common characteristics, then sampling from each group separately. This allows us to apply different sampling approaches to different parts of the population, optimizing both effectiveness and efficiency. The key benefit is that we can focus more testing effort on high-risk or high-value items, while testing fewer low-risk or low-value items. This maximizes the effectiveness of our sample by ensuring we test the most important items while minimizing the overall sample size. For example, in an inventory with items ranging from $5 to $50,000, simple, random sampling would give each item an equal chance of selection. This could result in testing many low-value items while missing high-value items that present greater risk. Stratification ensures appropriate coverage of all value ranges. Additionally, stratification can improve the precision of our estimates because items within each stratum are more homogeneous than the population as a whole. This reduced variability within strata improves the statistical power of our testing, making our conclusions more reliable with the same or smaller sample sizes. Stratification formula. Here's the stratification formula that saved us millions in audit hours. N1 equals N times open parenthesis, N1S1 close parenthesis divided by S open parenthesis, Nisi close parenthesis, where N1 equals sample size for stratum 1, N equals total sample size, N1 equals population size of stratum 1, S1 equals standard deviation of stratum 1, and S of NISI equals sum of population. Size times standard deviation for all strata. This formula looks intimidating, but it's actually applying a simple principle. Allocate more samples to strata with higher variability and larger size. The product of population size and standard deviation, Ni sigma I, represents the relative importance of each stratum in terms of both size and variability. Looks intimidating, but here's the simplified approach that most firms use in practice. Stratum 1, high value. Test 100% of items over $100,000. These items are so significant that we test all of them. The risk is too high to sample. Stratum 2, medium value. Sample items between $10,000 to $100,000. These items are important, but numerous enough that sampling is efficient. We typically apply MUS within this stratum. Stratum 3, low value. Minimal sampling below $10,000. These items individually present low risk, so we test relatively few of them, focusing on identifying systematic issues rather than isolated misstatements. This practical approach balances statistical rigor with audit efficiency. It ensures comprehensive coverage of high-risk items while applying appropriate sampling to lower-risk items. The exact dollar thresholds will vary based on materiality, risk assessments, and the specific account being tested. Stratification, efficiency, calculation. Let's work through an example together to see exactly how much stratification can save us. Company has $5 million in accounts receivable. Without stratification using standard MUS, we'd need 225 samples. At 30 minutes per sample, that's 112.5 hours of testing, costing $5,625 at a billing rate of $50 per hour. With stratification, we'd approach it differently. Stratum 1, greater than $100,000. 25 items totaling $3,500,000, 70% of value in just 2.5% of items. We test all 25 items. Stratum 2, $10K to $100K, 300 items totaling $1,200,000. Using MUS, we test only 36 of these items. Stratum 3, less than $10,000, 675 items totaling $300,000. Using MUS, we test only 9 of these items. Total stratified sample, 70 items, 25 plus 36 plus 9. At 30 minutes per sample, that's 35 hours, costing $1,750. Savings, $3,875 or 69% of the original cost. And here's the kicker. The stratified approach actually provides better coverage of high-risk items than the unstratified approach, since we're testing 100% of the high-value items. Show me another technique in auditing that saves you 69% of your budget with more accuracy, not less. I'll wait. This is why stratification is considered a best practice for substantive testing of material accounts. It's not just more efficient, it's more effective at identifying material misstatements. Substantive procedures by assertion. Now we've got our sample size and selection method. Time to get our hands dirty with the actual testing. The specific substantive procedures you perform depend on the assertion you're testing. Each financial statement assertion requires different types of evidence and testing approaches. For the existence of accounts receivable, which addresses whether recorded receivables actually exist, we would typically send external confirmations directly to customers asking them to verify balances, test subsequent cash receipts to verify that receivables were eventually collected, examine supporting documentation such as signed contracts, shipping documents, and invoices. For the valuation of inventory, which addresses whether inventory is properly valued at the lower of cost or net realizable value, we would typically perform price testing by tracing recorded costs to vendor invoices or other cost records, test net realizable value by comparing recorded costs to recent selling prices, less costs to complete and sell, perform obsolescence reviews to identify slow-moving or damaged inventory that may require write-downs. The nature of these procedures varies based on the specific assertion being tested. Existence assertions typically require more independent evidence from outside the entity, while valuation assertions may rely more on analytical procedures and examining internal documentation. Remember that the purpose of substantive testing is to directly verify the monetary amounts of transactions or account balances. Each procedure should be designed to provide evidence about a specific assertion. The combination of procedures should address all relevant assertions for the account being tested. Importance of investigating exceptions. When you find exceptions, stop and investigate. Don't just tally them up and move on. Every exception tells a story. This is a critical aspect of audit sampling that's often overlooked, especially by less experienced auditors. Let me tell you about a time I found an inventory exception at a tech company. An iPhone was recorded at $699, but should have been $599. I could have just marked it as a $100 error and moved on. Instead, I investigated and found a systematic pricing error affecting thousands of units. That's the difference between a $100 misstatement and a $2 million misstatement. When investigating exceptions, consider these key questions. 1. Is this an isolated incident or indicative of a systemic issue? 2. What control failure allowed this error to occur? 3. Could this error type affect other accounts or financial statement areas? 4. Is there any indication of intentional misstatement that might suggest fraud? The answers to these questions often lead to additional audit procedures or adjustments to your audit approach. For example, finding a pattern of errors might prompt expansion of your sample, targeted testing of similar items, or revision of your risk assessment. Remember, exceptions are like cockroaches. When you see one, there are probably many more hiding in the walls. This isn't just a colorful metaphor, it's a statistical reality. The exceptions in your sample are likely representative of similar exceptions throughout the population. Proper investigation and follow-up are essential for understanding the true nature and extent of misstatements. Taint percentage calculation. We've selected our samples, we've tested them. Now comes the moment of truth. What do the results mean? This is where most auditors mess up, so pay attention. Sample evaluation is where sampling theory meets practical audit conclusions. No, I'm not using inappropriate language in class. Taint percentage is the key to evaluating sampling results. Here's the formula. Taint percent equals audit value minus book value divided by book value. The taint percentage represents the proportional misstatement in an item. It tells you how wrong the recorded amount is as a percentage of the book value. This is crucial for properly projecting sample results to the population, especially when using monetary unit sampling. A positive taint percentage indicates an understatement. The audit value is higher than the book value, while a negative taint percentage indicates an overstatement. The audit value is lower than the book value. The magnitude of the taint percentage tells you how severe the misstatement is relative to the item's size. For M use, taint percentages are particularly important because they allow us to project errors in proportion to the item's size. This makes intuitive sense. A 10% error in a $1,000 item represents a $100 misstatement, while the same 10% error in a $10,000 item represents a $100 misstatement, $1,000 misstatement. The taint percentage captures this proportional relationship. Taint percentage example. Let me tell you about a time I was auditing a tech company's accounts receivable. We found an invoice booked at $100,000, but the actual contract was for $70,000. The taint percentage calculation revealed the severity of this misstatement. Taint percent: $70,000, $100,000, $100,000, minus $30,000 divided by $100,000 equals negative 30%. This 30% taint was a red flag that led us to investigate further. We discovered that the sales team was consistently recording revenue at higher amounts than the actual contract specified, creating a pattern of overstatement. This eventually led to the discovery of a revenue recognition fraud scheme that ultimately led to the CFO's resignation. One sample, one calculation, one career-ending discovery. The taint percentage was critical here because it quantified the severity of the misstatement in relative terms. A 30% overstatement is clearly significant and warranted further investigation. Had we only looked at the absolute dollar amount of the error, $30,000, we might have missed its significance relative to the transaction size. In smaller accounts, a $30,000 error might not have triggered the same level of concern. This case demonstrates why taint percentages are so important in audit sampling evaluation. They normalize errors relative to the size of the items containing them, allowing auditors to identify significant misstatements regardless of the absolute dollar amount. This proportional approach aligns with the concept of materiality, which is also typically defined as a percentage of a relevant financial metric rather than an absolute amount. Projection methods overview. Now for the grand finale, projecting these errors to the entire population. Here's where it gets real. The entire purpose of sampling is to draw conclusions about the population, which requires properly projecting the errors found in the sample. There are several projection methods, but I'll focus on the three most common that you'll encounter in practice. 1. Mean per unit estimation. This straightforward method calculates the average misstatement per sampled item and multiplies it by the number of items in the population. The formula is projected misstatement equals average misstatement times population size. This method is simple but doesn't account for varying item sizes. Second, ratio estimation. This method recognizes the relationship between audit values and book values in the sample, then applies that relationship to the entire population. It involves 3 steps. First, calculate the ratio of audit values to book values in the sample. Second, apply that ratio to the population book value to estimate the true population value. Finally, calculate the projected misstatement as the difference between the book value and the estimated true value. Third mass evaluation. This complex but powerful method is specifically designed for monetary unit sampling. It involves calculating the most likely error, MLE, based on taint percentages, then adding precision elements to calculate an upper misstatement limit, UML. This provides a conservative estimate of the maximum likely misstatement in the population. Each method has its strengths and appropriate applications. The choice depends on the sampling method used, the nature of the population, and the types of misstatements expected. For MUS, which is commonly used for substantive testing, the MUS evaluation method is most appropriate. MUS evaluation components. When evaluating MUS sample results, you need to calculate 3 key components. First, the most likely error, MLE, which is our best point estimate of the misstatement in the population. The formula is MLE equals the sum of taint percent times book value times population value divided by sample value. This gives us our best estimate of the true misstatement. Second, the basic precision, BP, which accounts for the possibility of misstatements in the items where we didn't find errors. The formula is BP equals population book value times open parenthesis risk factor divided by sample size close parenthesis. This represents the sampling error at our desired confidence level. Third, the incremental allowances. IAs for each error found, which quantify the additional uncertainty introduced by each error. The formula for each IA is IA equals population times risk factor times taint percent divided by sample size. These three components are combined to calculate the upper misstatement limit, UML. UML equals MLE plus BP plus total IA. This UML represents our conservative upper bound on the misstatement at our desired confidence level. The decision rule is straightforward. If UML is less than or equal to tolerable misstatement, we accept the recorded balance. If UML is greater than tolerable misstatement, we can't accept the recorded balance and need to either request an adjustment or perform additional procedures. This statistical approach provides a defensible basis for our conclusions, which is especially important in high-risk areas or when facing regulatory scrutiny. MUS evaluation example. Let's calculate a real MUS evaluation together. Imagine we have a sample of 225 items from a $5 million accounts receivable population, and we found 6 errors. The errors have the following book values and taint percentages. Error 1, $12,000 with 30% taint. Error 2, $8,000 with 25% taint. Error 3, $5,000 with 100% taint. Error 4, $9,000 with 40% taint. Error 5, $15,000 with 10% taint. And error $6, $11,000 with 15% taint. Assuming our sample represents $2,500,000 of the population, let's calculate the MLE. MLE equals the sum of $12,000 times 30% and $8,000 times 25%, $5,000 times 100%, plus $9,000 times 40%, plus $15,000 times 185%, 10% plus $11,000 times 15%, times $5 million divided by $2.5 million equals 3,600 plus 2,000 plus 5,000 plus 3,600 plus 1,500 plus $1,650 times 2 equals $17,350 times 2 equals $34,700. Next, calculate the basic precision. BP equals $5 million times open parenthesis 3.00 divided by 225 close parenthesis equals $66,667. Then, calculate the incremental allowances for each error. For example, for error 1, IA 1 equals $5 million times 3.00 times 30% divided by 225 equals $20,000. If we sum all 6 IAs, we get total IA equals $146,668. Finally, calculate the upper misstatement limit. UML equals 34,700 plus 66,667 plus 146,668 equals $248,035. Since our tolerable misstatement is $100,000 and UML, $248,035, is greater than tolerable misstatement, $100,000, we cannot accept the recorded accounts receivable balance. This mathematical conclusion has real-world implications. We would either need to propose an adjustment or perform additional procedures to refine our estimate. Documentation requirements. Documentation is the unsung hero of audit sampling. When the PCAOB comes knocking, good documentation is your best friend. For planning, document the following elements in detail: population size and characteristics, clearly identifying what is included and excluded; sampling method selected, specifying whether you're using MUS, classical variables sampling, or another approach; sample size determination, including the formula used, and all inputs to the calculation; risk assessment considerations that influenced your sampling approach; and tolerable misstatement and its basis. For execution, document these critical elements: specific items selected, maintaining a complete list of all sampled items; procedures performed for each item, tailored to the assertions being tested; results for each item, including both the recorded and audited amounts; and exceptions found and their causes, including any patterns identified. For evaluation, document these essential components: projection method used, such as mean per unit, ratio estimation, or MUS evaluation; confidence interval achieved, including both the point estimate and upper bound; comparison to tolerable misstatement and your conclusion; and final conclusion and its basis, clearly stating whether you accept the recorded balance, request an adjustment, or perform additional procedures. Remember the auditor's mantra: not documented, not done. If it's not in the work papers, it didn't happen. This isn't just bureaucratic box checking. It's essential protection against regulatory scrutiny and legal challenges. Sampling superpower principles. As we wrap up today's whirlwind tour of audit sampling, let me leave you with what I call the sampling superpower principles, the key takeaways that will make you a sampling expert. 1. Sample size is a mathematical decision, not a gut feeling. Use the formulas. Professional judgment has its place in auditing, but sample size determination should be grounded in statistical principles. The formulas we've discussed provide an objective basis for your sample size that can withstand scrutiny from reviewers, regulators, and courts. 2. Stratification is your best friend. It saves time and improves effectiveness. By focusing more testing effort on high-risk or high-value items, stratification optimizes both the efficiency and effectiveness of your testing. The dramatic efficiency gains we demonstrated earlier aren't theoretical, they're achievable in practice. 3. Taint percentages tell the story behind the numbers. The proportional measurement of misstatements provides crucial insight into the nature and severity of errors. Pay attention not just to the dollar amount of misstatements, but to their magnitude relative to the item size. 4. Projection of errors requires precision and professional skepticism. Proper projection techniques transform your sample results into meaningful conclusions about the population. Be rigorous in your projections and conservative in your interpretations. 5. Documentation of your sampling approach is your shield against litigation. In today's regulatory environment, comprehensive documentation isn't optional. It's essential for defending your work and demonstrating due professional care. Conclusion and next class preview. When you leave this classroom today, you're not just carrying formulas. You're carrying the statistical tools that form the backbone of the $50 billion global audit industry. You're carrying the same techniques used by Deloitte when they audit Apple, by KPMG when they audit Amazon, by EY when they audit Facebook. These aren't abstract concepts or academic exercises. They're practical tools used every day by auditors around the world to reach conclusions about vast populations of transactions and balances. The ability to examine a small sample and make statistically valid projections to entire populations is what makes large-scale audits possible. Sampling is the superpower that allows you to make million-dollar decisions with confidence. Master these techniques, and you'll never be intimidated by massive data sets again. You'll be the one who knows how to tame them. Remember, in the world of auditing, it's not about counting everything, it's about making everything count. Class dismissed.